you start working with clients, you can have two people, same situation financially, but their risk profile, their risk appetite is totally different.
Guest speakers and their companies on this podcast are not affiliated with or endorsed by LPL Financial.
Hello, everyone. Thank you for tuning in to Our 2 Cents on Your Dollars. And I'm James Enriquez. This is Leo Chang, Alexis Villarreal, and James Credo. Today, we're going to be talking about a riveting topic, portfolio construction. So let's get started. How do y'all build a portfolio? Where do you start?
It depends.
Oh, that's I love that answer, actually. Depends on what?
Man. You know, when I first started reading about portfolio construction, I thought there was only one solution, which is you go 100% stock. You're not supposed to have any emotions. You ride the ups and downs, and that's how you maximize returns. And then as you actually work with clients as a practitioner, you really get to a situation, especially when you're trying to, if you're really trying to develop a customized portfolio, customized service, and it's very specific to the client, their risk profile, I mean, their objectives, then you get to where you end up saying it depends.
I think it's even easier than that, right?
Right.
You got a small account, a couple stocks here. You got a medium-sized account,
Right.
a couple mutual funds. You got a big account. We start doing all these crazy things. I think that that it depends. I think really depends on the size of the client and also, too, what it is that they're trying to do, right? You have some people that are always trying to beat the market and do all these things. We try to tell them can't do it, but yet they still want to participate. And so I always try to figure out what is it they want to do and then try to figure out, okay, this is what you really should be doing. Let's stick to this process. And so I think portfolio construction at the beginning was kind of like what you said, right? Just throw some things together off of some list. And then, I don't know. I think it's going to evolve quite a bit.
When you all say what they want to do, what do you mean? Like what they want to do 20 years from now? Or do you mean like how do they want to invest their money? And when I say what do they want to do in 20 years from now, do they want to retire on a beach or do they want to own a stock? What do you mean what they want to do?
Yeah, like for example, somebody comes into the office, they want to retire in 20 years. So as a younger practitioner, and that, you know, you read stuff what Warren Buffett says, and then you're thinking about what your professors told you in your economic classes, which is you want to maximize return. You build a diversified portfolio of stocks, and then you throw away your emotions. And this is how you maximize returns and get to your goals a lot faster. But when you start working with clients, you can have two people, same situation financially, but their risk profile, their risk appetite is totally different. And so now as a practitioner, you're making adjustments. The one client that has a higher risk profile might take you up on your recommendations of, we're going to go 100% stock and be aggressive. And then the other one, you're not taking as much risk, so you're not going to have the same return, or you'll have lower returns. So now you're going to have a conversation. How are we going to make it up? Well, you're going to have to save more. And this is where your client now has an option. Okay, I understand where James is coming from. I think I'm going to go with having less returns, but I'm going to save more to reach my goal. And that's actually, in my opinion, a very difficult thing for practitioners to say to clients, because many financial advisors don't want to say the phrase less returns from a competitive perspective. In my opinion, they're kind of afraid to say that because another advisor can say, well, if you work with me, you'll make more money. But this is where you have to be confident as a practitioner that you really know your client, and then the client can tell that you have their best interests at heart, and that, I'm telling you can make more money investing it this way, but it requires you to stay invested during 2008, during the pandemic, or if we have a president that you don't like, And this is where I think every practitioner, and what we strive to do as a team is really have a customized relationship with the client. And I mean, I could use an extreme example that I've said to a client, just to drive the point, which is, if you're really that afraid, we might have to go cash, but we're going to have to save a whole lot more to reach your goals. So that's why it depends.
Do you take the same approach?
Well, time is a big factor and a huge variable in the decision making process when it comes to the construction aspect. Informing clients, hey, your idea and your plans, to build that house, or your kid starting college in 3 years, we have to really understand the risk aspect of what we're trying to accomplish and mitigate expectations a little bit. Because I think, we talk about portfolio returns and we benchmark them, and we look at, how the markets are performing from a whole, and people rely on that and kind of measure their portfolio returns to what that is. And a lot of times we have to temper those expectations and get individuals to understand, hey, the way that we're invested in the construction of your portfolio is not the S&P 500. It's not the Russell 3000. So for us to compare it apples to apples is inaccurate. And the reason for that is because your goal is to, help your daughter get married in 3 years with this money, And so if that's the idea, the amount of risk we take on is vastly reduced than, say, us trying to plan for your retirement in 15 years. And so that time frame plays a significant part in the way that we make those recommendations, and having clients understand, hey, we're taking on less risk because your need is a lot higher, and it's a lot sooner than any other goals that you may have. And so we have to utilize certain investment strategies and certain investments that the total return is going to be a lot lower, but the risk involved and associated with it is going to be significantly less as well.
So are you all saying that if it's a shorter time horizon, then you're gonna have less in stocks?
Yes.
Okay.
Yeah. If the end goal is there's going to be a liquidity event in a shorter period of time, then absolutely, recommendation is going to be utilizing assets that have lower level of volatility associated to them, especially for clients that are risk averse naturally. So,
yeah. Okay. So what if retirement's 5 years away, but I'm an early retiree? So I might spend 20, 30 years in retirement. So by what y'all are saying, are you saying that I should be ultra conservative, like have more of my portfolio in something conservative?
I'm gonna go with Credo's answer. It depends.
Okay.
That's where you actually got to be very careful, and then where you actually have to use cash flow based financial planning software to really show the client, based on your time frame in retirement and your expenses and inflation rates
And the size of assets that they currently have.
size of assets, your health, and other objectives you have during retirement, and the way we're currently investing is this money gonna last? Because when you ask a client, Mr. and Mrs. Client, during retirement, do you want to make sure that this money will go to zero right at age 100 as much as possible? Or do you want to make sure there's a little bit of a balance for a charity or your beneficiaries, right? And so this is where customization really, really matters, because you can build a portfolio in so many different ways with so many different outcomes. And that's why you have to really ask the right questions and try your best not to make any assumptions about the client. And the perfect relationship is, the client is sharing as much as they can, and and then you're taking that and then showing the numbers, and then come to an agreement. Yeah.
So how does the size of my portfolio determine my asset allocation? Or you know what? I think that's the first time that term was introduced right now, asset allocation. So what is asset allocation, and how does the size of my portfolio determine that? I'm asking you because you mentioned about the size of your portfolio.
Yeah, so I think the size of the portfolio is a factor, right? In the sense of that sometimes will help determine how much of a need they're going to have off of that portfolio to fund their retirement, their lifestyle. As I've had individuals that retire in their earlier ages, obviously their portfolios, if they're smaller, right, we obviously may need to take on more risks so that way they can sustain their same lifestyle without having to, start living without certain things that they're accustomed to. If their portfolio is larger and they have less of a need for their portfolio, then that's where it starts coming some of those conversations where there's a lot of flexibility in they don't need to rely on it, but they're going to use it to live off of. And at some point, the conversation changes on how are we going to effectively transfer this over to the next generation. And so that's where the size of the portfolio becomes a factor in regards to determining how much really of a draw we're going to have to utilize this assets for. And that's where you got to just have that conversation with the clients. What are you trying to do? Here's what we have in place. The more information they give us, the better we do our job. It's always that simple.
So who wants to pick that up? What's asset allocation?
Asset allocation, the way we define it is really what you're invested in, and the structure and the things that we are investing in within the portfolio. And so that's evolved significantly because we have so many different defined asset classes that we're able to invest in, especially with the evolution of cryptocurrency now over the past couple of years as well. But the asset allocation for us is determining where, how much we're going to invest dollars for the individual, how long we're going to invest in those dollars in those specific classes as well too. And so it's strategic in the sense that that plays a major part based off of what the client needs and the client goals are. When we're going through the portfolio construction process, for me, and this is a philosophy, and I think that the team shares this philosophy. What we're trying to do and what we're trying to accomplish from a goal perspective is we're trying to maximize returns with as little risk as possible. So when we're doing a lot of the planning process, we talk with the client, we speak with the client and an individual, and they have a specific goal in mind. We're using retirement as an example. So the individual wants to retire, they have a date they want to retire. We know how much they need in retirement, so we have a figure in mind. What is the lowest level return that we possibly need to be able to accomplish the goal we have for that individual for retirement? Because if we have a lower expectation from a return aspect, that means we don't have to involve as much risk in our portfolio. And so what that allows us to do is then go to our portfolio construction process and determine how much are we putting in bonds, how much are we putting in cash, how much are we putting in U.S. equities, international equities, commodities, whatever the case may be. And so that process and constructing what that portfolio looks like and determining the allocation and percentage of those specific classes, that plays a major role in really determining probability of maintaining a goal or coming up short.
I guess when we all got started, right, allocation used to be stocks versus bonds. And then I think as we started to evolve in regards to our practice, we started to realize that other classes need to be implemented, alternatives, cash. And so we started to implement more of different asset classes into our portfolio construction. And I believe that that's kind of helped us have a good process in place where all of us here have a good idea on each of our clients might have different levels of risk, but we know that all of our level 5 risks, with the ones that are the risk takers, I know what their portfolios are doing. I know what type of returns they're getting. I know what investments they're in. As the same thing for the person that's a low level risk. We've all been able to collaborate and be able to put our heads together, figure out what are the best things that these individuals can utilize to basically have happier clients. Because I think sometimes it's real easy to make this seem like it's rocket science, and we can jazz it up if we need to. But the reality is it's pretty straightforward, right? A good diversified portfolio, maximizing all the different asset classes, right, from big companies to middle companies to small companies, putting that mix together based off of what their comfort is really kind of I guess the secret sauce that we put together here.
So how do y'all determine a proper asset allocation? Do you take the number 100 and subtract your age to figure out how much you need in equities?
Good old rule of thumb.
Have y'all heard that one?
Yeah, when I first saw that, and I did it for me, I think I was like in my 20s when I saw that, and I was like, Warren Buffett told me to go 100% stock.
Yeah.
so this is already going to reduce my return. So, and that's the problem with rules of thumb. It doesn't help with your specific situation, but it's there as a guide. And I think that's why there's so many ways to get to one place, you know. That's why there's so many weight loss programs, but we all know how to lose weight. I mean, most of us, I think, which is exercise more and eat less.
Nice big jacket.
This is a 44. And but when you research is it fasting? You know, there's so many options. It's the same thing with finance. There's so many ways to get there, but what everybody's looking for is what works specifically for me. And I'm sorry to keep repeating myself. That's why I keep saying it really depends, because everyone is so different. The math is, like Alexis said, is actually the easy part. It's customizing it to the client. Is
an emotional aspect of it. That's what I feel.
That's the fun part for me as a practitioner.
Yeah.
So
yeah, it's different. I mean, we all kind of have a little bit different. Like, I believe in real estate, right? And I'm comfortable telling clients to have real estate in their portfolios. There's some individuals, you know, especially in our industries, that's like, no, you got to be invested in, you know, these mutual funds, ETFs, and that's it. Real estate is silly, things like that. And you know, I to me, that's you're contradicting yourself by making those assumptions as well too, because we always talk about diversification. That's a topic in portfolio construction. And so, you know, each individual has a philosophy when it comes to construction process and asset allocation. And I'm a believer that real estate can be, and if you are capable of having that as part of your portfolio, then more power to you. But it's just to each their own. It's their level of comfort. And I think the biggest part of defining that is understanding the risk associated to those different asset classes, right? Understanding the risk associated with real estate, you know, illiquidity, things like that. Understanding the risk associated to you know, fixed income options and equity options. And so, you know, the philosophy and the process we all share in the diversification aspect of it, but there are some little things in the portfolio construction and the asset allocation aspect that may be a little bit different depending on the practitioner as well too.
Okay, so you mentioned the word fixed income right now,
mm-hmm.
and earlier you mentioned stocks. So how do you construct a portfolio, or what is fixed income? And are you buying individual securities in these asset classes, or what kind of investments are you buying?
So we would define fixed income as bonds, CDs, longer term CDs as well, money markets, treasuries, lower risk lending instruments for the most part we would define as fixed income. And so that part of our portfolio tends to carry a lower level of risk than equities, which are stocks. And in most circumstances, we utilize that piece of the asset allocation to help reduce overall risk and provide a little bit of income, which is in the name itself. And so that, in comparison to stocks and equities, plays a little bit of different part as far as what it's doing for the portfolio. Now, it also depends on the environment, right? We just went through a very interesting environment in 2022 where bonds, relative to what they do, were riskier than stocks because of the interest rate environment we're in during that time frame. But historically speaking, they carry a lower level of risk. And so that part of the portfolio we use to stabilize the portfolio as a whole, provide some stability, and provide some income. And it plays a huge part for our retirees. It plays a huge part for individuals that do carry a lower risk tolerance. But it's extremely important.
For the fixed income space, I've used mutual funds, right, to kind of broad base cover it in our portfolios that we typically use. We do use mutual funds, I believe, for almost all of our fixed income space. I think as of recently, we've started to look and do some research. Is it better to find something that doesn't have somebody managing it, oversight, right? Try to reduce our expenses that way. I have done individual bonds. They were kind of gone for a long time because rates were so low. Now that rates have come back up again, it at least looks somewhat intriguing at this point for our individuals that are looking for some sort of fixed income and looking for something to where that's either tax free. Those are the situations where we use actually individual bonds, but for the most part, it's typically a mutual fund for our fixed income space.
Okay, so what's the difference between a mutual fund and what was the other term you used?
An individual bond?
No, the exchange traded fund?
ETF.
ETFs.
ETF. Yeah. What's the difference between those two?
Or where you're getting at is passive versus active, generally speaking. So when exchange traded funds were first created, you're taking a passive approach. Means you're buying the marketplace, like the S&P 500, and you don't have any research. You're just trying your best to mimic how the S&P 500 looks. So, and that's what you're investing in. With mutual funds, you actually have a team of analysts and advisors that are researching the individual stocks, and they are trying to outperform the market, or in this case, the S&P 500, or a passive basket of investments. And so the fees or the expense ratios for mutual funds are higher because you are hiring experts to pick the stocks that they think that will outperform its benchmark. And so that's the difference between exchange traded funds and mutual funds.
ETFs also have a different level of tax efficiency associated to them as well. As James pointed out, the portfolio managers have free reign in regards to that, in regards to the portfolio, right? They can purchase, sell really any of the holdings within that fund whenever they want, whenever they feel necessary, based upon their due diligence and what they have to meet when it comes to the portfolio management. With ETFs, that's not the case as far as the holdings go. The term exchange traded funds plays a part in what actually happens. The funds in a mutual fund are actually bought and sold. And so when you hold a mutual fund in what we call non-qualified accounts, these are accounts that are taxable on an annualized basis. Those funds, when they are sold and bought, cause taxable events. And those taxable events are received, and you actually get them in a 1099 at the end of the year for those non-qualified accounts. Mm-hmm. In ETFs, they're more efficient in the sense that they're actually exchanging and trading the holdings instead of buying and selling. So the difference is that, for example, let's say a portfolio manager owns Coca-Cola stock. They do their due diligence. They realize that they're not favorable for whatever reason with Coca-Cola anymore, and they want to shift to a different product in that industry, different company in the industry. And now they want to own Pepsi Well, they can go out to the marketplace and look for or find another individual who is willing to and able to hold or wants to hold Coke, and they hold Pepsi. And so they find a trading partner, and what they do is they trade the holdings with that trade partner, and they exchange it in the value of which they hold that individual stocks. And there's no buy and sell situation that occurs. And so it reduces the buying sell action that then does not cause a taxable event. And so it becomes a lot more efficient for individuals in non-qualified accounts over time. And because there's not that consistent portfolio management like James brought up, the cost to own it is significantly less as well.
So earlier y'all mentioned that portfolio construction depends. Is one of the determinants the type of account? Because you just mentioned that exchange traded funds are more tax efficient and holders of non-qualified accounts should consider those. So does that mean tax deferred accounts such as individual retirement accounts could hold something different and should hold something different?
Yeah, so I think when I first got started, not fully comprehending financial planning and where to have stocks and which accounts and how they all kind of work together. It used to be you're a level 5, so all your accounts look like level 5. It used to be to where you're a level 3, so all your accounts look at level 3. And then you start growing and you start collaborating with other individuals. And you start talking to their CPAs and tax professionals. You start to realize there could be a whole lot better way of doing this. And so if clients have assets and they have retirement accounts and non-retirement accounts, there's definitely a lot of flexibility in controlling which accounts have stocks and which have bonds. So somebody could be a level 5, but their accounts don't look like that. One account might look like, let me take it back. A client might be a level 3, right? Somewhere more in the middle. They might have an account that looks like a level 5, and they might have an account that looks like a level 1. But when you blend them all together, their overall accounts look like a level 3. And that's being done for a very specific purpose because, going back to Leo's comment, there might be some positions that might create taxes. We can shelter those by putting them in the retirement accounts. And then we can put the more, the ones that have more tax favorable in the assets that are not in the non-retirement accounts. And overall, right, that impacts their taxes, that impacts their returns. And so at the very beginning, it was just you're a 5 across the board. And as we've evolved, we've realized that you can have a big impact on individuals by just putting their assets in the right place.
And when you say level 1, level 5, you mean like 5 being the most aggressive and a scale of 1 to 5 with risk in a
Correct.
Portfolio, 1 being the most conservative, 5 being the most aggressive.
Yeah, okay. I'd say the 5, you're 100% stocks, right? Pedal to the metal.
That strategy has a name for it. It's called asset location.
Housekeeping, folks.
Housekeeping.
Yeah.
Asset. I mean, we'll go into this in another podcast with retirement, but one of the retirement accounts that are very favorable from a tax perspective are Roth IRAs. And so with Roth IRAs, you have a huge benefit in that the account grows tax-free over time. And so with the asset location strategy, why would we not want to maximize that tax benefit to the highest of its capabilities, right? And so when you start to look at overall risk tolerance and overall perspective of what the client is trying to do, that account has the most favorable tax treatment. That for us is such a huge benefit. And so when we look at location, we look at the allocation as a whole, that account, we typically want to maximize the total return. And so that's taking on more risk. That's having, higher level of equities in something like that in comparison to something that, we'll talk about this as well, but traditional IRAs that are tax deferred, and just depending on what the tax environment is, you may be paying more taxes later on. So it might not necessarily behoove us to maximize returns in an account like that.
Okay, so y'all are singing music to my ears. You're talking taxes. Okay,
we know that gets you hot.
So Leo, you mentioned about the tax efficiencies of certain investment vehicles. Okay, so mutual funds tend to be less tax efficient, right? So if surely none of you would do this, but if you decided to buy a tax inefficient mutual fund in a non-qualified account, are you all considering capital gains distributions, potential capital gains distributions when you're about to purchase that? And what are capital gains distributions?
The answer is yes. And for the most part, it's gotten easier because on the equity side, where we decide to use active management or mutual funds is on actually just very specific asset classes where we think research will actually still make a difference because of inefficiencies. So we still use mutual funds for international stocks, emerging markets, and small caps. And so this is where typically with active management, there's definitely more trading there because the portfolio managers are trying to take advantage of those inefficiencies and outperform their benchmarks. And so this is where on an annual basis, you have to really run a capital gains report to understand what's going to be the tax impact for that client at the end of the year based on what the portfolio managers have been buying and selling. So if they sold something in that fund at a gain, and even though your fund as a whole, let's say, lost money that year, but they've sold something at a gain, that is taxable to you. And so that's something where you have to be proactive and make sure you run a capital gains report for that specific, or for all your funds that you're using, to make sure what the tax impact will be for that year. And have a conversation. Is there an opportunity to offset some of those gains by selling something at a loss?
Yeah, so towards the end of the year, right, is typically when these when they're like about to create these capital gains.
I said proactive.
Well, it's typically towards the end of the year is when they create these things. And I know that early on in my career, I was told, like, be careful about buying mutual funds towards the end, because somebody before me, luckily I never did this, they bought an investment for somebody, and right off the bat they got taxed, and they're like, I just bought this thing. And so that's it. That's a conversation I've never had to have with a client, but I know other advisors have had that, where they basically got a double whammy and they didn't even realize what happened.
If you're lucky, you'll end up with a closed-end fund that distributes in January.
Oh, my favorite.
Those are definitely fun.
Okay. So, let's talk about that. Let's geek out a little bit, guys. All right. So, I mentioned closed-end fund right now. We talked about capital gains distributions kind of being all over the board. It could be January, it could be December.
Yeah.
Are you all actively looking at this for clients? And what's been y'all's experience? Are clients, if they're managing their own portfolio, are they looking at this?
Typically not. They're not. For us, it plays a factor, right? But the funds we're using, there's so many variables in determining how and when we're using them. We've talked about cost. On another podcast, Artie was here. He talked about the portfolio manager and how big of an impact it was for him early on in his career determining what funds to use. That still does play a part to a degree for us as well too. Efficiencies with the fund, tax implications. There's another thing that we've looked at regarding mutual funds. So, all right, we're geeking out a little bit, right? Please. So mutual funds categorize themselves in certain asset classes, right? And so when we look at the U.S. equity space, there's a ton of different asset classes and defined areas that are determined when we're looking at portfolio construction. One being U.S. large caps from a growth perspective and from a value perspective. So typically we define growth companies, U.S. large cap growth companies, as companies with very large capitalization that are in sectors that are considered growth sectors: tech, AI, healthcare, consumer discretion, things like that are more from a growth perspective, right? And so that is a category in itself. Value is a different category, but those are also can be considered U.S. large cap companies. The value sectors consists of, energy, utilities, consumer staples, things like that, right? And so when we're constructing a portfolio, we're wanting to have representation from both of those asset classes. We want funds that have U.S. growth companies, and we want funds that have U.S. value companies. A lot of the time, these mutual funds will provide a name for that mutual fund, right? XYZ Growth of America Fund, JXL Value, U.S. Value Fund. And so in those circumstances, people tend to just look at the name, look at the performance, say, oh, this is a really good performing fund that owns U.S. value companies in them. But when you start digging a little bit and start looking at the makeup of the fund, the allocation within the fund, you start seeing, wait a second, this value fund owns NVIDIA? What? This value fund has, 3.5% of the total holdings are in IT and tech. And so that skews your portfolio makeup pretty significantly, because the risk associated to that fund isn't really defined based upon the name and based upon the way that it is defining itself as far as what you would benchmark it against. And so what we've tried to do is we've tried to look a little bit deeper into those funds, and what the way that we define it as purity. So there's a level of purity for those funds. And so if that fund says it's a value fund, we want to make sure it's as pure value as possible. If that fund says you
mean like most of their holdings are in that area?
Correct. Yeah. If that fund says it's a U.S. mid-cap value, mid-cap growth fund, it's as pure as it possibly can be, because if we're owning a U.S. growth fund, we're also going to own a U.S. value fund. And the last thing we want is for those funds to overlap in the sense that they're owning the same things. Because if they're owning the same things, that means we're increasing risk because our allocation owns too much of one specific category. So that level of purity is really important in determining which funds that we're implementing. And it helps us over time get a better idea and understanding as far as if there are deficiencies and we are trailing performance-wise, where that may be happening from, and we can kind of address that and make adjustments.
Yeah, it's a question about the clients. I always feel like the clients pick their mutual funds by whichever one did awesome last year. Whichever one did awesome, that's the one they want to start buying into. Not sticking to a process of any sorts, right? But they just basically look at, hey, that one did really good, I need to buy that one. Not understanding that, right, they're basically buying at the high, right? Instead of going with the process of asking, what is it that they actually need to be filling in? What gaps do they have? So.
Yeah.
But sometimes, though, as fun and cool these strategies are to implement, like Alexis mentioned, asset location, tax loss harvesting, some clients don't really understand the benefit until you actually either show them on their tax returns, or you actually have to point it out. Some of I think, because I consider that part of their rate of return. If you're able to manage their taxes or avoid paying a higher Medicare premium, higher Medicare premium because you did tax loss harvesting, you did asset location, or even, I think that's some of the fun things to do, in terms of financial planning, and you just have to be comfortable doing it, even though some clients might not actually realize that's what you're doing, but I think it's an integral part of financial planning. And
it's funny, you mentioned that there's so many variables,
right?
I like to try to sum it up as we're trying to enhance your risk adjusted net after tax return,
Right.
because it's not what you make, it's what you keep. And we're not tax professionals. This is not tax advice. We highly recommend you consult your tax advisor. But for example, you alluded to this, right? If you're a high income earner and you're subject to the net investment income tax, then all the income that's being produced off of your investments, you're assessed an additional tax. So if we can keep our risk-adjusted return high but make less taxable income, why not?
It's awesome. Yeah.
Yeah.
And clients really appreciate it too, especially when you're able to show a year by year comparison.
Yeah.
It's especially 2022, where I think it was 21, 22. Was that one of the worst years for capital gains?
Yes.
Right.
Yep.
And then you're able to compare like 2023, where you made in 22 you lost money, and then you see these capital gain distributions, and in 23 you made money, but you paid less in taxes. And that's when you get the aha moment, and then you're like, "Oh, I'm gonna keep doing this. This is, this is good. For
This is
clients.
smart.
This is smart and fun."
Yeah. I liked your idea about looking under the hood. I think 2022 was a perfect reminder.
Right.
You see a short duration or limited duration bond fund,
Right.
yet it's down double digits.
Right.
What's going on? This is not supposed to happen in a short duration bond fund. And you look under the hood, and it's a closed-end fund. There's leverage on it.
Right.
It's high yield. So So walk me through y'all's process. How do you look under the hood? You're looking at style purity. What else are y'all looking at?
I mean, you got to look. I think you already kind of bought it up, because even when you hear bonds in the industry, you think safe. It's there to offset the volatility and risk of stocks, but it's a competitive world, and so these investment firms and advisors, there's more and more of them, like Artie mentioned earlier, and so they gotta eke out every gain that they can against their competitors. So they'll take additional risk that you may not be aware of. So here, we use tools and our product partners to really understand what's underneath the hood. And so you're looking at things like, are they using leverage? The word short term is in there, but what kind of short term? Is it short term government, or is it short term high yield? And is it U.S. high yield, or are you talking about emerging market high yield? And so you have to really know the breakdown of that pie. Because if not, you're going to get those surprises when you have a bond fund that's acting like an equity fund in 2022.
Yeah.
So,
I've even seen some out there that have that word like income in them. They're stocks, but yet people don't understand. They see the word income on there, and they think they're automatically bonds. They have no concept and understanding of what's actually in there.
What's nice is we have a ton of resources and tools that provide that breakdown for thousands of funds. So we can pull up a fund and get a full breakdown as far as what it's invested in, what the allocation percentage is, things like that, to truly give us a better understanding and idea of what we're actually holding. But clients doing it on themselves, doing the portfolio construction process themselves, they don't utilize those tools. They don't. And I wish they had better access, and I wish they had better understanding of that, because that's a big part of the long-term diminished returns that they tend to see, and they don't really understand why, and they're questioning what the truth is behind the fund itself, and a lot of times it's because the fund isn't really what it says it is, and they don't really have the information to determine that.
Yeah. Okay, so I really want to talk about Sharpe ratios.
Ooh, wow.
Well, because we're talking about returns, right?
Yeah.
Okay, so if you have Fund A that had X return, and you had Fund B that had the same X return,
right.
but Fund A has less risk than Fund B,
Right.
which one would you prefer?
What's the name of the names matter? It's like branding, Who's
Who's the portfolio
Fund
manager?
A, worst Fund B.
Superior Fund A every single time.
Sold on the name.
Sold on branding.
Well, I bring that up because I think a lot of people sometimes neglect the risk part of it.
Right.
For sure they do. They just see the return. Why didn't I get that return? They don't understand that, right? Sometimes people are taking on a whole lot more risk to get the same return. And returns is a dangerous thing to be going after because I know he made a comment about S&P index and 100% stocks and things like that. Everyone always wants a diversified portfolio and everyone always wants to outperform the S&P index. It doesn't work that way. We are intentionally going to underperform a 100% stock portfolio over a long period of time. That's not our job. Our job is to grow clients' money in a way that they can sleep at night. Because I feel like a lot of times they say that they can be a level 5 risk until the very first little storm comes and they want to be a level 1 real quick. And I think that I think having that conversation with individuals as far as what this mutual fund's purpose is, what the investment's supposed to be doing, they're not doing the research, right? That's what they ask us to do. And I definitely think that clients are very uninformed.
Yeah, and we look at Sharpe ratio to determine.
Yeah, you're talking. James is talking about risk-adjusted returns. Your returns for every level of risk that you're taking, and in good times, actually, nobody really cares. I think you called it superior fun, and the other, what was it?
Worst
fun. So
Awful fun.
Very creative.
In good times, you just see the returns. You don't care the level of risk that other fund is taking because you just they're both doing well. It's in bad times that you're reminded that risk-adjusted returns really, really matter. And because, at the end of the day, it sounds all so easy, right? Maximize return, be aggressive, and then and stay invested. But in down years, when you see your fund underperform another fund that sounded or looked the same because you didn't look at the risk-adjusted returns, then it starts to matter. You start to question the fund that you have, and now you're thinking, can my fund recover? I didn't know it was taking that much risk for that level of return. Could this recover? Should I make a change now? And you start questioning, and before you know it, you're selling it, even though that fund, that's how it's supposed to behave in that marketplace, and maybe you were supposed to just wait because that's its risk profile. You know what I mean? But you didn't know that. You weren't anticipating it because you were comparing it to other funds in that category, and the other ones performed better. You just weren't aware how it's supposed to behave in different marketplaces, environments. So,
yeah. So I feel like it's a good stopping point, but I'm going to keep going. One more topic because you kind of alluded to it. Yeah. What do you mean efficient? Markets are efficient. Can you talk about efficient market hypothesis?
Man. So back in economics. Literally back in the day, what they're trying to say is that if you take the largest US companies, there's so many analysts looking at those companies. They're so well known. It's almost impossible to find a difference maker that a portfolio manager or somebody like myself, I have new information that nobody else knows. That's what they mean by efficiency. Everybody already knows the ins and outs of these companies because they're so big, they've been around for so long, that stock picking or research will not make a difference. So you might as well just buy and hold a basket of stocks because no amount of research will make a difference. So there are asset classes where we think that research can still make a difference because these companies, usually international or smaller companies, are not as well known. So somebody like, James Enriquez, if he's studying a small company stock, and that's his niche, he might find a company that no one has really researched, and he can find a gem, and his mutual fund can outperform the others because I did not research that company. It was not known to me. But for large company stocks, especially U.S. stocks, there's so many analysts covering them. It's going to be very hard for somebody to say, "Oh, I found something about Disney that nobody else knows."
Yeah. I think for individuals out there too, trying to determine and measure performance, if you are trying to do it yourself, there's a thing in the industry called R square that we utilize to
Did you just say R
R square. So what that does is it's a variable that determines your portfolio and what you're measuring it against. For instance, if you have a portfolio made up of all tech companies, Apple, Nvidia, Microsoft, Meta, and you're measuring against the Dow Jones Industrial Average, the R squared there doesn't match, right? Because the Dow Jones it is not comparable from a performance and from a risk perspective, right? So the formula in determining how you're measuring your performance, that variable is important because you want to make sure that you're measuring it up against something that is of equal value from a risk and return perspective. And so that's important for us when over time, when we're looking at our portfolio performance, right? What are we measuring it up against? And there's all these indexes that, over time, it'd be great to outperform. It's extremely difficult to do, but we can get a gauge and we can kind of get a better understanding as far as performance-wise, if we're meeting expectations, if we're underperforming, and if we are measuring ourselves against the proper indexes that we need to measure ourselves with. And so for individuals trying to do yourself, that's a really important thing to take a look at. Don't beat yourself up if your portfolio, underperformed the S&P by 2%, but, you own bond funds in it. But it wouldn't make sense.
Well, good deal. Well, let's sum it up with some actionable takeaways. Okay, so tell me if I'm right.
You're right. No.
Consider your risk tolerance,
Yep.
your time horizon,
Yep.
your goals to determine a proper asset allocation. Consider an active passive strategy. Look at Sharpe ratios to determine the risk adjusted returns of a fund. Consider the type of account you have. Is it a taxable account or a tax deferred account? Look at the tax cost of funds. We didn't really talk about rebalance, but rebalance your portfolio periodically. Anything else y'all would like to add?
It sounded like a lot.
It was like about 10 there, but what was the after-tax return? The one that you said, I think we needed that one.
Okay. All right. Here, shameless plug then. Yeah. You could just outsource it to somebody like us.
Sure could.
Oh, yeah, you could. You definitely could.
And that's because we probably left a little bit out. I was trying to shorten it for people, but
Right.
Yeah.
Right. It's all fun, folks. It's all fun.
Yes. As I mentioned at the top of this podcast, riveting. But we really appreciate y'all listening. That's our 2 cents on your dollars.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.